What if the tariff war didn't hurt either side the way the textbook says it should? China just reported a staggering jump in industrial profits, and US corporates are also reporting record beats. So, who actually paid the tariff given that the consumer price index has come out pretty benign? Hey all, welcome to ShareTreck, where science meets investments, and I'm your host Raj. Friends, this is part 2 of our series Who Ate the Tariff? Today we dig into China's profit rebound, US corporate resilience, and where the economic pain actually landed. I was prompted to make part 2 because in part 1 we had said that neither the consumer nor business ate the tariff, and we just assumed that China with 5.3% GDP was also just fine. It turns out that today's surge of profits in industrial output for China means that even China did not eat the tariff. So today's video tries to reason out how this could have happened and where the tariff actually went. Let's start with the numbers. In September, China's industrial profits surged 21.6% year on year, following a 20.4% raise in August. For the first 9 months of 2025, industrial profits were up 3.2% year to date, with private firms leading gains while state-owned enterprises lagged. Those are big moves, the fastest profit growth in nearly 2 years, and this is coming from Reuters and Bloomberg reporting on NBS data. At the same time, US corporate reporting has been unusually strong. FactSet and Bloomberg's trackers show that roughly 85 to 87% of S&P 500 companies that have reported so far bet EPS expectations, one of the higher beat rates we have seen in recent quarters. FactSet also shows blended S&P earnings growth in the high single digits in Q3. And the US CPI, well, as covered in part 1, headline CPI rose modestly in September and core CPI increased 0.2% for the month, soft enough to calm fears of broad pass-through to consumers. The combination, booming corporate profits in both China and US plus soft headline inflation, is a puzzle. 4 practical explanations can be used to explain China's sharp rebound in industrial profits. First is low base effects. Last year's profit figures were weak in many manufacturing segments, so year-on-year comparisons are amplified. Improved capacity utilization and policy support is another aspect you could look at. Beijing has pushed to curb destructive price wars and rationalize capacity in heavy industry while targeting support towards higher value manufacturing, helping margins recover. The other aspect you can talk about is export demand and reorientation. Despite tariffs, demand from non-US markets and higher value export mixes have helped manufacturers sell more profitable goods. And finally, private sector strength versus state-owned enterprises is an area that we can look at to get some clues. Private firms in China, for instance, are more flexible to cut costs and shift products, and they have driven most of the gains, while many state firms remain weighed down by commodity exposures and slower restructuring. So China's manufacturing sector hasn't collapsed under tariffs, it's adapted. That doesn't mean there aren't structural weakness in the economy, but it does show that businesses found levers to protect margins. Now look at the US side. If tariffs supposedly raise import costs, why did US companies report such strong beats? Well, practical mechanisms that companies could have used include passing through prices selectively. Firms could have increased prices in targeted categories where the market tolerates it while absorbing costs elsewhere. Research and trackers show tariff pass-through has been meaningful in some goods categories, apparels, certain appliances, coffee, but uneven across the economy. So the other aspect to look at for the US side would be inventory management. Many companies ran pre-tariff inventories or delayed restocking temporarily, avoiding higher landed costs. Once restocking happens, some pressures show up, but the timing can mute the immediate CPI signal, and that is one aspect that we have to consider. Now, operational efficiency and cost cutting is another factor that could have helped the US side. Persistent focus on efficiency, automation could have helped keep the earnings intact. Now, you also look at mix and margin. When you look at bigger companies, sales composition shifted towards high margin products and services, a pattern visible in sector-wise reporting. Now, Some firms have diversified suppliers away from the tariffed countries or moved production to third countries that aren't subject to the same duties. JP Morgan trade analysts and corporate filings document such shifts to a certain extent. These actions do not eliminate tariff costs completely, but they can significantly blunt the visible impact of headline profits and CPI. So this is some of the ways in which I can try to rationalize what is happening. It's possible that the pass-through is partial, lumpy, and category specific. One clear empirical fact is that tariff pass-through is far from uniform. Academic and policy work in 2025 finds that pass-through rates vary, sometimes high in narrowly tariffed categories and lower in other and often delayed until inventories are replenished. The St. Louis Fed and independent groups have estimated measurable pass-through into goods prices in 2025, but the aggregate CPI effect gets diluted by services and by consumer substitution. That explains why tariff-sensitive categories may show price increases while headline CPI remains tame. I would also like to point out that goods are just a slice of the CPI basket, and consumers can substitute or delay purchases while firms can tighten costs. Now let's put it all together. Theory says tariffs cause one or more of three things: higher consumer prices, lower importer margins, or lower foreign seller prices. The 2025 data suggests the burden was shared and uneven. Now, consumers paid some of it in tariff-sensitive categories. Researchers and the BLS both show localized price increases, but the broader consumer price environment did not blow out because substitution, service price trends, and timing effects seem to have diluted the headline. It also seems US and Chinese firms absorbed part of the cost via efficiency gains, pricing strategy, and shifting product mix. Many firms also used resourcing or shifted final production to other countries. Corporate filings show these tactics across multiple industries. Anecdotal evidence suggests that foreign suppliers and exporters, including China, faced margin pressure in low-value exports, but benefited when they moved up the value chain, found other markets, or benefited from policy support. China's 21.6% profit jump shows the country isn't simply losing out. So, what is the answer? Well, no single actor ate the entire tariff bill. Instead, the cost was distributed across consumers, firms, suppliers, and through time, often disguised by corporate strategy and macro effects. For investors, here are practical fact-based checks to monitor. CPI component trajectories. Watch tariff-sensitive categories such as apparel, household goods, certain food items for sustained pass-through. BLS monthly tables are in place to check these kind of data. Now, we also have to look at corporate restocking and guidance. Look for companies' commentaries about inventories and input cost inflation in Q4 earnings calls. If firms start warning about restocking at higher prices, margin pressure could show up in the subsequent quarter. We should also watch China export composition. We should monitor whether export growth is concentrated in high-value segments, that is EV batteries, high-end equipment, versus low-value consumer goods. We should also watch for evidence of shifting supply chains and third market demand, like in Southeast Asia, Europe, Latin America. That's where exporters can blunt tariff pain. Trade research and corporate supplier disclosures matter here. Tariff policy can change quickly. Any new tranche of retaliation changes pass-through dynamics and investor risk pricing. All of those things will change. Like, for example, Trump just suddenly announced that he's going to put an additional 10% tariff on Canada. We don't know when that is going to tick in and on what categories and how it will impact us. So all of those distortions definitely happens. I would say that from my perspective, having burnt my fingers looking at the fundamentals and shorting the S&P 500 and the FANG stocks, I feel that it's time for us to more focus on the technicals, because the charts are reflecting the aggregate of what the investors are feeling. So I'm putting more focus on technical analysis right now than on the fundamentals. But that means that I have to be very alert and have to watch my portfolio very closely and start selling. So today I initiated a little bit of long positions. I sold off gold. I took a lot of profits in gold and I sold it off. I'm waiting to pick it up again after it meets my support levels. So my question to you is, what have you seen in your shopping cart or in your company's numbers? More price hikes or still the margin squeezes? Drop a comment with one example. I read everyone. If you found this article helpful, please press the like button. It helps other investors find this analysis. Thanks for watching. And if you're not yet subscribed, can you please subscribe and help grow the channel? Also check out my Substack. It's absolutely free. I have more details in my Substack for this video and any other long form video that I make on this channel. That brings me to an end of this video. I'll catch up with you again in the next one. Bye.